My name is Charlotte Godby here. I've been with Equifax over 25 years. In 2017, I formed a team specifically focused on the fintech space. We focus a lot on financial health and inclusion. So again, thank you for being here. Our first topic today, our first panel, is going to be talking about data science innovations for more inclusion and responsible financial services. So with that, I'll go ahead and pass it over.
Thank you, Charla. Thank you, Charla. And thanks to the Equifax team for sponsoring this entire track. I think this is a pretty critical topic, pretty essential to the future of finance in our country. I'm a partner with Flourish Ventures. We were actually established to back innovations that promote financial health, that build a fair finance system. So I'm really excited to be talking to my panelists. I'm not looking at my phone while I'm doing this. My notes are here, so I warn you ahead of time. I'm also just excited to be here in person. I wasn't here last year. It's just great to be at an event with fellow travelers in the space and to be together and to work together in this important sector. So we're going to discuss the role of data science in expanding access to financial services and making sure those services are delivered responsibly in the current economic climate, as my colleague just mentioned earlier. So we are living through a pretty extraordinary moment when it comes to generative AI. You know, every day we wake up, there's something new and extraordinary happening. It is indeed very exciting for some of us. For many of us, it can also be unnerving. But the truth is, when it comes to data analytics and data science, it's already been a big part of the financial system for a number of years. And in fact, machine learning methods have been pretty instrumental in expanding access to credit. Equifax is a part of that story. And in fact, I believe we are now getting better at figuring out how those models actually work. Mm-hmm. We're going to hear from a colleague here about that, and also whether they are indeed, you know, reaching the people we want them to reach. Mm-hmm. And so as we weed out bias and improve transparency. The truth is the economic climate has changed. You know, we saw this early in our portfolio at the beginning of last year because we do have some fintech lenders in our portfolio of folks working in the lending space. Part of this is that we came down from, you know, pandemic forced savings, came down from pandemic access to economic benefits. And of course, with this looming uncertainty about a recession and the high interest rate environment, we're likely to see more tightening credit. And we're already seeing that with a number of the publicly traded fintech companies. So we have an excellent panel. Kudos to the Fintech Nexus team and Equifax pulling this together to understand all of these issues, to talk about fairness, talk about access, talk about primarily the role of data science. So I'm going to ask the panel to answer a question, and as they do that, also introduce themselves. And, you know, try to keep it brief. So the question is, how is the current economic climate, the current conditions that we are in, and it's a transitory period, so no one really has the sort of monopoly on the truth right now. But it's a transitory period, but how do you see it? How is it changing access to credit from where you said? And how are both traditional and modern lenders responding to that? Go ahead, Harold.
Good. Good morning, everybody. Excited to be here, and thanks for attending. My name is Harald Schneider. I'm the Global Chief Data and Analytics Officer with Equifax. Been here for almost a year in June. In terms of my background, just very briefly, I've been in the space for almost a quarter of a century. Started my career with Citigroup and then had different roles both in the data analytics space, finance, risk management, and also as a general manager at Citigroup, Capital One, Visa, and a couple of startups. To go back to Kabir's question, it is indeed a transitory time, and so what we're seeing is probably what you guys see as well. We've obviously still seen pretty robust growth in terms of consumer lending. So when you look at the data through February of this year, we've seen very strong growth in a lot of the lending verticals, both on the secured and unsecured side. Credit card balances were up 90% year over year. Until the end of February, we saw growth in the loan space as well. We do see in March, though, for the first time that trend is slowing down. And so when you look at the latest data we have, there is actually a drop that we've seen across the board in our stats for March. So, you know,
Sorry, drop in what?
Imbalances. Imbalances, right? So that's one thing we're seeing. On the flip side, you know, we are seeing delinquencies trending up. But again, interesting because in March, for the first time, we saw a stabilization. So, you know, we were obviously coming from historical lows, so not surprising that we saw this, you know, reversion to the mean, and across the different asset categories, we're still below the pre-pandemic levels, with auto really being the one vertical where we're eclipsing the pre-pandemic delinquency levels. So what have we seen in the spaces as expected, and that's reflected in some of the latest delinquency trends. We've seen lenders pull back. You know, the areas where we've seen probably the most tightening are as expected at the lower end of the spectrum. So, you know, we've seen folks in the subprime and near-prime space take in the most proactive steps in terms of correcting their policies. And, you know, in terms of verticals, we've definitely seen some tightening across the auto space, the personal loan space, and, you know, there's somewhat of a mixed shift. We've seen a little bit more of a pullback by some of the traditional fintech lenders, and to an extent, we've seen traditional lenders stepping in and closing some of the gap. But that's just a little bit of a 2-minute overview of some of the key trends that we've been seeing as we're very closely watching and trying to share some of the insights with the community.
Thanks, Harold. Laura, on your end?
Well, hello, everyone. Thank you so much for being here, and thank you, Equifax and Fintech Nexus, for having us. I'm Laura Kornhauser, one of the co-founders of Stratify and our CEO. So what we do is we offer credit risk decisioning and scoring tools for lenders. And also, we recently launched a product called Unbiased, which is focused on fair lending risk assessment, so providing bias detection and, importantly, mitigation tools to financial services customers, primarily lenders, of course. And behind both of these products is our mission to enable greater financial inclusion while also helping financial institutions better manage and mitigate risks. So what we're seeing, and this is from the lenders that we're working with right now, is of course aligns with what Harold was just sharing of, you know, we are seeing a focus on, of course, sound risk management practices and visibility into how existing portfolios are performing, and the need for, I would say, tools to help with that visibility on an ongoing basis, not just from a credit risk standpoint, but also from a fair lending risk standpoint, which I'm sure we'll talk about today. But one thing that I think is really interesting that we're seeing from a few of our lending partners is not actually tightening up or not actually pulling back, and keeping, I'll say, rich ways of measuring credit risk on the table, and what those lenders are actually seeing, because they are not using, I'll say, blunt instruments to chop their credit box back or pull their risk back, is they're actually seeing massive increases in volumes and good performance as well. So I think there is a real opportunity right now for lenders, especially lenders that are able to deploy more advanced tools, deploy those responsibly, of course, but deploy more advanced tools to measure the underlying true risk of borrowers, for them to really win out as many others are, again, I'll say, using blunt instruments to pull back on risk.
So you're saying that the tightening market, tightening might mean you're going to sort of say, I'm not going to lend to subprime, but you're also saying it tightens competition.
Yes, absolutely.
And so lenders are going to lean in on newer methods, and you're seeing that with some of your customers.
We're absolutely seeing that. And, you know, very specifically, you know, and this relates to exactly what you were speaking about. Certain lenders are going to their credit policy and just, you know, I'll say, raising a FICO cutoff, for example. which then leaves a lot of, as it relates to the discussion we're talking about today, has a very poor impact, I'll say, on the inclusion of their models and policies, and then also leaves a lot of good borrowers out in the cold.
So
searching
that's the
for
blunt
options.
instrument.
Yeah, that's the blunt instrument I'm talking about. So I think there's a massive opportunity for lenders that, I'll say, use much finer precision tools to, again, still be focused on and managing and monitoring risk, but do so in a much more precise, much less blunt way.
Cool.
Yeah.
Nat?
As usual, Laura is stealing all of my thunder. So Upstart is an AI-powered platform. We work with about 100 lenders today across both the sort of original marketplace banks that distribute into the capital markets and then traditional lenders, banks and credit unions that hold loans make loans with our technology and hold them on balance sheet. And so we have a lot of diverse partners with a lot of different interests in different parts of the credit spectrum, risk spectrum. And so the innovation that Upstart's AI modeling has sort of inspired, our slogan is, seamless credit based on true risk. So that essentially means rather than use that blunt instrument that says everybody below some certain line is just not even eligible to apply for a loan, our models would suggest that millions of people below these sort of artificial cutoffs are going to repay loans. And so that means that there's this huge opportunity to serve that constituency in a way that they haven't been served before with better, lower APR products, provide them access to credit in a really simple way. I think 75% of the loans are now through a mobile device. This is, 75% or more now approved instantly, so, fully automated. So this is a real revolution in the user experience, which is something that's really important, is just this ability to go through the application process and just be delighted by how quickly you can get quoted a fair price, a really simple product in personal and auto refinancing and auto in a sort of a digitally enabled dealership experience. So that's Upstart, and I do think that there's a lot to talk about where we are in the cycle, but we have seen a significant improvement coming off of the early 2022 period, where I would say people were coming out of the pandemic, had adjusted their spending habits to a lot of stimulus, but had not yet sort of fully absorbed the full stack of both inflation and then their real expense. So we've seen that the key metrics is really the savings rate, and that has really started to improve. And with it, we're seeing improving credit performance and so forth. So that's kind of the state of play in personal and auto.
So it's almost that all three of you are saying that there is a transition to perhaps a better moment. Even though we are generally in a transitory moment, we are entering perhaps a slightly better moment than we have been in the last few quarters.
Yeah, and remember that even with even if defaults are rising, if you think about, pricing is also rising, which can reduce the amount of people that will accept the loan, but that's okay, right? If they have an option and they don't like the price, if they decline the loan, that's not ideal, but it means that they're managing the situation in the best possible way for themselves, and then the pricing change, that person may be riskier today than they were in 2020, right? But just because of the macro environment. And so that's another focus of ours, is to this new Upstart macro index that we've released, is to try to very precisely measure where somebody's risk profile is at any moment in time.
Sudhir?
Yeah, excited to be here, and also with the esteemed panel. So my name is Sudhir Chava. I'm a professor of finance at Scheller College of Business at Georgia Tech. I also have an appointment in College of Computing with my original degree in computer science. For the last 25 years, most of my work has focused on research in various aspects of financial services and banking, fintech, household finance, in terms of looking at consumer decisions for the consumption, for the retirement decisions, for the spending, investment, and all that. And again, with Equifax data, we have been able to do a lot of that research. I also run a financial service innovation lab, which has many partners, with Equifax being one of the primary partners, where around 100 students, including around 10 PhD students and postdocs and others, we work on all these aspects. We build models of credit risk to machine learning models, NLP models. We do a lot of work on various aspects of credit risk to the household finance. As coming back to the question which Kabir was saying, maybe as an academic, I take take a step back. As I always joke with my students, the best time to write a paper about a banking crisis is 5 years after the crisis. So it's just in time for the next crisis. So in terms of the last 10, 15 years, I think is unusual in terms of the low interest rates and what it meant for how consumers got used to it, how lenders got used to it, and all the standards in some ways. But now if you look at the senior lending officer survey, which came in a few days back, many banks have started tightening the credit. And again, it's disproportionately felt on certain segments because in terms of how it works and commercial real estate, they started tightening that up. What it means is because of the SVB and others, most of the attention has been focused on right now on the liability side of the balance sheet. Banks are worried about it, or lenders. So what's the funds, where are the funds coming from, what are the cost of funds? That will differentiate those which are a better source of funds and cheaper source of funds. They can actually take advantage of it. But also there's going to be some issues on the asset side, especially the commercial real estate and others. They start, the value goes down. That's going to have a spillover impact into, again, the kind of decisions they make in terms of the loans they make. So that's going to be those lenders, whether they're fintech lenders or large banks or medium banks, which have a better source of funds and which have better risk controls and can actually take advantage of it.
And do you think they are even more favorably positioned given the broader mid-size banking, turmoil that we're in right now?
Yeah, I believe so. There's definitely going to be, because some of the regional banks to mid-sized banks, they might be cutting back a bit more than they should because they're worried about what's both on the deposit side, but also the portfolio might be a bit more on the commercial real estate and others. So that's going to give opportunities for fintech lenders, but also large banks.
Yeah. Well, we're seeing just on that, there's a huge demand for something that people weren't as interested in maybe when interest rates were so low, which is high yield, short duration, right? So that's exactly what a fintech personal loan, delivers you, right? Because you have prepayments and you start to get performance pretty quickly. And so that high yield, short duration for a bank that's trying to match liabilities and is sort of worried about holding on to this kind of long-term, bond portfolio and how am I going to match that? It's a really desirable product on that front.
So in order to meet this moment, more precision tools, product innovation, but also just new data sources, right? That's been the mantra for a number of years for all of us, is how do we leverage a wider source of data? I think, Harold, at Equifax, you've been working on this front. What are you seeing in terms of going beyond traditional credit files? Any performance data, any outcome data that you've gathered on that front?
Yeah, so there's obviously a lot of data that we continuously are looking at. It's the core of our business, but I'm just going to focus on a few areas that I think are probably particularly noteworthy in terms of their impact. So in terms of the credit files themselves, there's obviously an opportunity to expand and continue to include additional financial lending instruments. And so that's something we're have been continuously working on, and including more and more data sources, rent to buy, furniture financing, more short-term loans as mentioned. And so that's where we've been making significant investments and really trying to create more insights through that. Contrary to popular belief, a lot of those consumers are actually not unbanked. They are more underbanked, so the majority of them do have also traditional credit lines. But what it allows us is to create more of a 360 view and add additional trade lines that allow us to create thicker files and then better opportunities for lenders for risk assessment. The second area is utility payments, telco, pay TV. It's a space where we've been very active for a long time. 90% of adults in this country have at least one utility bill, right? So there's a really good coverage. And again, it's a space where we see an opportunity to really enrich the traditional credit data. And I'll talk a little bit about some of the results in a minute. The other area...
Just to clarify, Harold, are you enriching that already now, systematically across, or where do you enrich it?
So yeah, we have been working with many providers in that space and have been working with many large telco, utility, pay TV companies to help them with their underwriting. And so it's something that we've literally done for decades. And so it's something that we're now really more trying to bring into the toolkit of risk managers. The other area is payments data. There is additional insights that you see through credit card transactions, debit card transactions that we're studying. And then the last thing I want to mention is I believe affordability is an important aspect in responsible and inclusive lending. And so we are also very much focused in supporting our clients in using income and employment data even more effectively and comprehensively, because again, your ability to repay is obviously driven by your income, right? And so that is a fourth category of data that I think is really critical.
Before you mention outcomes, Nat, did you want to say something?
Yeah, I just wanted to say the importance, just for those who don't live in this world, the importance of the alternative data is so important. So the blunt instrument of saying everybody below 700, need not apply, is not eligible, is really driven by an accuracy problem, right? Is that you can't get an accurate enough view of the people that are below that line to figure out who will repay the loan and who will not, who has the ability to repay and who does not. And so the alternative data, revolution is what is enabling platforms like Upstart to give the approvals. And so the numbers we have is, 40 to 50% higher approvals of Black borrowers at 25% lower APRs. I mean, these are significant gains. These are not small gains, these are big gains. And the big gains are driven by using a lot of different data sources, getting a more precise view of each individual, and then being able to go below these and say, we don't need a cutoff. Not everybody below the line is going to get approved, but many can and will repay. And so I think that it's really a kind of a change of thinking for a lot of institutions that say tightening means just putting in place a higher credit score minimum, right? Cutoff or a DTI minimum, or these very sort of blunt instrument tools. And instead you say, no, we're going to reflect the rising macro risk. We're going to reflect, the change in the customer's position related to a lot of the latest information and trends out there. But we're not going to just simply give a blanket no. And I think, especially in unsecured and auto, these are loans that people need to manage their lives, to get out of credit card debt, to avoid the cycle of debt, to make sure they have an auto to get to work. And so if you tell somebody, if 4/5 of Black borrowers have a credit score under 700, and you use a 700 credit score, and you have a loan that starts at $1,000 or $1,500 that can really benefit that population, I don't care what your fairness equity numbers are, you're just cutting out a vast majority of the population who could really benefit from your product.
Nat is alluding to the outcomes.
Yeah, no, I mean, I totally agree with Nat. Thank you. And just to build a little bit on some of the numbers that Nat mentioned, with some of the solutions that we're now have in the market, if you look at the people applying for lending products on a monthly basis, just using the utility data and some of the additional credit data that we've been enriching our credit files with, we're now able to approve an extra 20% of consumers that are looking for lending products. Obviously, without increasing risk, right? 20% of credit-seeking consumers we can now make better decisions on, which is very powerful for those.
And you can attribute that to new data,
Yes.
primarily.
Yes, yes. And, the other thing is also, it's not just that they become scoreable, but we're going back to my comments around thicker files. What we're seeing now is that we're able to move 15% of consumers from the subprime space to get near prime or prime offers. So, they're not only scoreable, but they're also now benefiting from the ability to get better pricing and better products. So really big improvements. 20% is very meaningful.
That's awesome. And I think there is a panel or two later today on alternate data, if I'm not mistaken, at least one panel. So I hope people will attend that. Laura, I wanted to talk to you about bias, one of the challenges with precision tools. By the way, congratulations on your funding round.
Thank you so much.
It's we should all clap because it's hard to raise money, but it's also great to have another fintech female CEO.
Thank you so much, Kabir.
But you're involved in different parts of the credit process, but one of the areas is to sort of identify and mitigate bias. And part of the challenge and by the way, this is required by law.
Yeah.
And part of the challenge has been that, these precision tools, as you call them, tend to be hard to explain at times in terms of what the outcomes are. And so how are you going about doing that? That's one of the kind of interesting new ways in which Stratify is working.
Yeah, absolutely. This is core to the problems that we're addressing and the problems we're helping solve. We are not going to Charla's introduction, we are not in the data business. We are in the tools on top of the data business. And one of the ways that you can actually leverage these great alternative data sources that we're speaking about and get to those more precise risk measurements is by using machine learning based approaches. But as you mentioned, many of those approaches are black boxes, or if there are ways to explain them, it is done via models on top of models that, in our personal opinion, may make it explainable to, again, a select few, but often not partners both within a lender and partners externally, whether those be auditors or regulators. So we are very focused, and we do this through a method that we've developed now for almost 15 years, going way back before the company was founded. But we do this with a method that effectively combines more traditional methods of risk evaluation and decisioning with cutting-edge machine learning approaches, such that you have models that are fully interpretable. And what I mean by that is you see exactly how the model is working. And importantly, you also then have the ability to change how the model is working. And this is where the topic of bias really comes in. Any model, if fed a biased data set, which I would argue almost every single data set is biased, right? It's not a question of if, it's a question of how. If you just feed that data set blindly and you don't have the model, and you have the model set up to have basically one goal, which is optimized performance, you are going to get a biased model. Now, there are methods that are being used by many, or I shouldn't say many, by, I think, leaders in the space, which I think we have a number of those, thankfully, on the stage today, where we introduce another factor that is being optimized, and that is a factor around fairness. That is what we are doing with our unbiased solution, is enabling a lender to not just search for a model that's going to assess risk very well and drive great financial performance, but also will not go out of bounds from a fair lending standpoint.
And I think the big message is that this is an ongoing intervention.
You are so
right. This is not a one and done thing. You have to constantly be monitoring your models, constantly be tweaking them. And that's the business opportunity, but it's also the need.
And that is, to your earlier point, it is the law. I would say it is a part of the law that, because there hasn't been great tools to help do this in the past, that's where Stratify comes in. Because there hasn't been great tools to do this in the past, folks have been doing it when the model is deployed and maybe on an annual basis.
And we know about the FDIC's consent order.
Correct.
With cross-server. It's focused on fair lending.
Yeah.
And what struck me was that it actually mentions third parties, use third parties.
Yes, yeah.
So how does this change the landscape? And is this like a threshold moment, or are we reading too much into that?
I don't think so at all. I think that combined with comments that came out of the CFPB at NCRC's Just Economy Conference a few weeks ago, which were very focused on, and this was from Patrice Ficklin from the CFPB, spoke about the importance of regular search for LDAs, and I'll let Nat talk a lot about LDAs because he's great on this topic, but also that proactive fair lending risk assessment. So it's not okay to, again, have it be one or done or have it be something that's done, if that, on an annual basis. It's important for any bank that is originating the loans to have this kind of visibility for any partners that they're working with as well. And it, I think, is a huge clarifying time in the industry where, again, this is something that has always been required, but there haven't been the tools to enable a bank to do it effectively and efficiently. That's changed, so.
Yeah, the tools have changed. There are a number of companies, as you mentioned, but interestingly enough, even though the regulators want this, they have not been comfortable with the tools.
Correct.
You know, they themselves are unsure of the tools because it's sort of, as you said, model over a model kind of situation. So that is, I think, instructive in the consent order situation, because you were part of this study with FinReg Lab. I'm on the board of FinReg Lab, and part of the effort was to get the regulators to get comfortable with what your tools can actually do.
Absolutely correct. I think that, again, this black box problem, if you will, has always made many uncomfortable, the regulators, chief among them, but also many financial institutions as well.
Yes.
And I think that the work that a number of us are doing to increase that visibility into machine learning such that it really does not have to be a black box. And if deployed responsibly, and if deployed with we think some very interesting methodologies and technologies, you can actually still, you can said another way, because machine learning, I think, has become an overly used buzzword, you can benefit from data in a scalable and automated fashion without running into additional risks.
Precision tools, scalable
Correct.
and automated fashion.
Yeah.
New vocabulary, no AI,
Correct.
machine learning.
Correct.
By the way, we have 7 minutes here. That's what the clock says. That's for me to remind you, if you have questions, do put them in. I don't know where you put them in. Oh, okay, there you go. And they'll show up on the monitor here, and I'll try to incorporate them. We don't have a lot of time, and I have a few more questions. So Nat, we started talking about the regulators and the policy environment. You've been involved in this effort that is sort of, I think it says more than fair.
Mm-hmm. Yep.
Please talk about that, and what does that mean, and what does it mean for the industry?
I think it's a really a multi-sector effort with this.
Oh, by the way,
Yeah.
I should mention, congratulations to Laura for getting the funding, but also congrats to Nat for being the top 100 best golfer in the Washington, D.C. area, by the way. He's number 3 on the list. This is pretty critical for his job. You have to appreciate this.
These are these things you'll never live down. But I did. At least I was above President Trump and President Obama. So I have bipartisan golf superiority, which I will gladly take. No, More Than Fair, and I encourage everyone to look at morethanfair.com. So it's an effort between the civil rights community, the consumer advocates, and industry, research organizations, to really come together more frequently to hash out how are we going to move in a safe and responsible way from the older tools, which we know, there's nothing more sort of biased or black box than the human brain, and so the old ways of black borrowers walking into bank branches being made to wait an extra 40 minutes compared to white borrowers, the history of intentional redlining. So you move from that world through efforts to make things certainly more egalitarian via sheer number models like a FICO or a traditional score, to today where you can use an enormous amount of data to try to get this very precise and accurate view of the customer's risk, while you hope not having that be presented in a way that sort of reinforces traditional disparity or discrimination. And so in order to get from here to there, it really requires a multi-sector conversation, which is what's happening at More Than Fair. We're meeting and working frequently, and I think that that sort of opportunity.
And
when
who are the
peop-
members again?
So the members include, Upstart, Lending Club, Stratify, Solus AI, but also organizations like National Community Reinvestment Coalition, the Leadership Conference on Civil Rights, NCLC, National Consumer Law Center. So some
And
of
it's morethanfair.org.
it's called morethanfair.com.
.com.
Yep. So morethanfair.com, and so that whole effort has involved quite a lot of work in order to sort of understand both the concerns on the advocate side, but also the opportunity. And the statistic that really gave rise to Upstart was that while 80% of American adults had never defaulted, only 50% are considered prime. Right? So there's this huge delta between people who have ever made a mistake in their lives as it involves credit, and yet who are actually given even a shot at a prime or near prime type of credit opportunity. So that's a data problem, that's an AI problem, that's a perfect machine learning problem, but it really takes all of us coming together to make sure that that is done in a way that is not sort of reinforce the biases of the past.
Great. And what else are we seeing in the policy realm? I'm going to monitor the questions. I think there's one we can end with. So I'm going to just be able to probably pick one. But Nat and Sudhir, what do you expect more to see in the policy realm? Maybe, for example, Nat, on the 1033, do you think that's a significant development in this space? You heard Harold mention the impact just in expanding data access. And Sudhir, it would be great to hear from your research efforts with Equifax. What are you seeing that might contribute to this? But maybe Sudhir, go ahead first.
First I'll talk about the research, the partnership with Equifax. Part of what we do is the responsible and sustainable finance is a major theme of the Financial Services Lab. But we need data for that. Without the data, we can't develop any kind of insights which might be of help to practitioners, policymakers, and consumers. One example which we have been able to do with the data I'll mention is, for example, student loans, 45 million student loans, $1.7 trillion, and always a big issue, might be a bigger issue in the future. But in 2020, in the pandemic, there's a forbearance put in place. Supposedly temporary forbearance has gone for almost 3 years. We look at what's the impact of that, and what we find is initially there's a jump in credit scores, but then afterwards the loans have gone up. But the bottom line is now 3 years down the line, many of these consumers have almost a 12% higher credit card debt, they have more auto loans, and now the defaults are starting to pick up. That means a temporary policy change might in fact, if you don't address the underlying issue, might cause issues in the future for the very borrowers that the policy is supposed to help. So those are the kind of insights that we can draw on with the data from Equifax, and we are looking at the payments data also, DataX and others, to understand more so it can help policymakers also.
And this is Financial Services Innovation Lab?
Yes.
At Georgia Tech with Equifax. Okay. Nat, what about on 1033 or other policy efforts?
So 1033 data access rule. I was working on the Hill in financial services policy when we passed Dodd-Frank, and the idea that the consumer is the one who controls their own data and should be able to use that data to get the best possible product for themselves is sort of enshrined in law. And the question is, how is that going to be sort of put into practice when the rubber meets the road because of the security concerns on the part of lenders and so forth. We've had a well-developed ecosystem now, companies like Plaid, Finicity, to help people access, get the best products they can by working with whatever provider they want to harness the power of their data. So that's an important one. 1071 is an important small business reporting around fairness. That's new. That's been a long time in the works. Again, the data revolution really means that there should be more comprehensive testing all the time. I mean, Upstart is testing for fairness on our platform constantly, and we test the entire loan stack. People who are doing this selective testing only and then one swap in, often what constitutes in traditional lending a less discriminatory alternative search is just, can I remove FICO score? Nope, my model becomes too inaccurate, therefore I'm going to stick with what I've got. And that, in today's world, is just not what is possible or sort of up to snuff. And people should be doing really comprehensive testing on their whole platform and using the tools like Laura's company's developed to see, can I be a fairer version of myself even within the credit box that I've got.
We're going to go over a few minutes. Sorry about that. But one question, Laura, did you want to get in on that?
Yeah, I just wanted to say really quickly, I think that is such an important point that Nat just brought up. This is what so many lenders are doing right now. They're saying, I can't get rid of FICO score, so I will just allow that or another indicator, this is not a bash of FICO score, another indicator to drive bias in my model because I can't do a good model if I just get rid of it. That is a completely archaic way of testing for less discriminatory alternatives in the world that we live in right now.
There are static post facto rather than
it is the bluntest of the blunt instrument, and the fact that lenders are still doing that and thinking that that is sufficient is a tragedy. I'll just say.
Harold, this first question, it's been upvoted 3 times, so I have to ask it. Is there a case for bureaus opening up their scoring models?
So
the answer is yes.
So similar to what Laura said, we believe that the explainability of models is key. It's not models on top of models. That's not explainability. So we've really been, for years, I can take credit for this because this has been my predecessors, been very heavily investing in explainable solutions around our models. We have lots of patents in that space. And so, yes, we will continue providing more transparency. We're doing work on helping not just our customers, but also consumers understand better why the model provides certain scores. So, yeah, we're certainly looking to continue being more and more transparent in that space because it's critical.
I would encourage everyone to look at the report by FinReg Labs on Shapley values, which is the real tool that is emerging to explain both more complex models, but also simpler models. They have shown that these models can be explained, and so that concern that they're a black box, I think, it's not that it's not a concern, it's always something you grapple with, but the entire system has always had black box elements from the beginning, the dawn of lending, of somebody lending based on, whatever they thought personally in their mind, the feel of the, I got a good sense because my sons play Little League with his son. I mean, so these kind of dynamics have always existed. But these new tools that FinReg Labs is really testing have been proven to be effective, and that's what sort of companies like Stratify are starting to harness to help.
And I'll answer the one last question: which carries more weight, inclusion or accessibility? I think that's a false dichotomy. Well, please join me in thanking our panel, and please stick around for the next set of panels.